Good morning. Today is Monday, August 18th. This is your Clubhouse Insider, a little market update. So the market's opening up flats already this morning, which is usually great, right? We love stability, but don't let the quiet start fool you. This is actually a pretty big week. We're leading into September where all eyes are on the Fed for rate cuts. But Thursday is a jobless claims report. So all eyes are on upcoming jobs data because these reports carry major weight in shaping inflation. So any kind of inflation outlooks, ultimately what the Fed does next. Jobs report equal inflation signals, so mortgage rate movement. So stay alert. If you are interested in refinance or purchasing a home and you're in contract right now and you want to avoid any guessing, we are at 10-month lows. We are sitting near the bottom of that 10-month range. But remember, mortgage rates don't wait on the Fed. They move based on expectations. So upcoming data, especially on jobs and inflation, will tell us whether this window of lower rates will last or not. So take a look here. You can see that we've been up and now we're coming back down. A little bit more positive data, we could start coming down towards the 6% range, but don't expect any huge jumps. But if anything, bad jobs reports, it'll jump backwards faster than it will jump forwards. So with that in mind, we look at the 10-year Treasury. We talk about this. If we want to see really low rates, we need to see this number come under 4. So we got to about 4.2 or so. In the old days of COVID with the great low rates, this was under 1. So what we're looking for right now in a 1 month, okay, is right here. We just need it to come down under 4 and you'll start seeing really great rates. So this is positive, very, very positive, trending downwards. We just need this to keep continuing. So the other factor here is we really want to pay attention to rates going into a Fed rate cut. So this is a really good article. I would check this out if you're interested. But mortgage rates are at lows right now. We could see more volatility after the Fed cut. Now there's expected to be a couple cuts, but what happens with rates is they predict. Mortgage rates actually rose after the last Fed rate cut. So central banks gearing up, trying to get that Fed funds rate, right? They're not cutting mortgage rates. They're cutting the federal funds rate. So we already hit low. So this is what the market is saying because they're already expecting that cut. That's why we're seeing the dips. So this is a great article. I would take a look at it. But being in the 6% range, we're getting very close. That's where a lot of economists say is a healthy market. So pay attention. If you are doing something with your mortgage right now, like refinancing, if you like it, lock it is always the best advice. If you're getting savings and you want to make sure you maintain those savings, now is a great time to lock it in, take advantage of almost a year's worth of lows and, start moving your payments forward. The best for your budget and your family. Real estate is a long game. So today, the biggest thing that I want to highlight, other than just what to expect as we enter into some exciting times with the Fed, is as a broker, what that means, flexibility. So we have an edge as mortgage brokers that other lenders don't have. With just one credit pull, we can shop dozens of lenders to find the best loan term. So whether you're buying or refinancing, the flexibility is a huge win for clients. So let us compete and prove it to you. Give us a shot and follow and like and share this post to help spread the word that brokers are winning in today's market. So let's keep more families in control of their home ownership journey. Have a great week, everybody.